Today, we're going to try and crack the code on one of the most fundamental questions in all of finance. How do you actually figure out what a stock is worth? Let's jump in.
So it really all boils down to this, right? When you buy a share of stock, what are you really buying? Is it just a ticker symbol, a number that flashes on a screen all day? Or is there something, I don't know, something more fundamental under the hood that gives it actual tangible value?
Well, the answer, at least in theory, is, well, it's surprisingly simple. The true value of a stock is just the sum of all the future cash you ever expect to get from owning it. But, and this is the big but, there's a crucial twist. All that future money has to be brought back to what it's worth today. Honestly, if you get this one idea, you've got the key to everything we're about to cover.
Okay, so to really get that, we need to wrap our heads around a core concept called present value. Think of it like a financial time machine. It's the tool that lets us figure out what money we're promised in the future is actually worth in our hands, right here, right now.
So, what exactly is present value? It boils down to a super simple idea. A dollar today is worth more than a dollar tomorrow. I mean, it makes sense, right? You could take that dollar today, invest it, and have more than a dollar tomorrow. Present value just, well, it flips that logic. It asks, what's that future dollar worth today?
This whole process is called discounting, and it's really just a three-step dance. First, you have to project, make an educated guess about the cash you think you'll get in the future. Second, you got to choose something called a discount rate. This is basically the return you're demanding for taking on the risk and for, having to wait for your money. And finally, step 3, you just do the math to pull all those future values back to today.
Okay, now you're going to see a formula on screen. Don't panic. It looks a little intimidating, but I promise, it's just the fancy mathematical way of saying what we just walked through. All it's saying is that the value today, that's V0, is just the sum of all those future cash flows, where each one is shrunk, or discounted, by your required rate of return R for how far in the future it is. So let's break that formula down piece by piece. V0, that's easy. It's just the value today, the price. CF stands for cash flow. That's the money you're expecting to get down the road. And then there's R, that's super important discount rate. A great way to think about R is as your personal hurdle rate. It's the minimum return you need to even consider making the investment. If it can't clear that hurdle, you walk away.
All right, let's make this concrete. Imagine I offer you an investment. It pays you $100 next year, $150 the year after that, and $200 in year 3. Now, let's say your personal hurdle rate, your R, is 10%. You take each of those future payments and discount them back to today. And when you add them all up, you get $365.14. So that's it. That's the absolute most you should be willing to pay for that investment today.
Okay, so that method is perfect if you have, 2 or 3 payments. But a stock, that's a whole different beast, right? You could hold a stock for your entire life, and the company itself could be around for hundreds of years. So adding up every single payment one by one, that's just impossible. We need a more elegant way to handle something that could, in theory, pay out forever. So, what is the cash flow we're talking about when it comes to a stock? I mean, what's the actual cash you get in your pocket just for owning it? Now, there are a few ways to look at this, but for the model we're building here, the answer is simple. It's the dividends. Those cash payments that some companies send out to their shareholders, usually every quarter. This brings us to a really interesting puzzle. How on earth do you put a price on a stream of cash that not only goes on forever, but it also grows every single year? You can't sit there with a calculator and add them up one by one, literally to infinity. That would take a while. And here is the solution. It's called the Gordon Growth Model. And honestly, it is an incredibly elegant, incredibly powerful little piece of financial magic. It takes that impossible problem, an infinite, growing stream of dividends, and it boils it all down to this one beautiful, simple formula. Let's check out the components here. We still have V0, the value today, and R, our required return. Those are familiar, but now we've got 2 new players. There's D1, which is the dividend we expect to get next year, and then there's G. This is the big one. G is the constant rate that we expect the dividend to grow at forever.
And this is why this model is such a game changer. Instead of that impossible task, trying to discount every single future dividend from here to eternity, this one little formula just gives you the answer. Now, there is a big assumption baked in. We have to assume that growth rate, G, stays the same forever. Okay, let's plug in some numbers and see how it works. Let's say a company is expected to pay a dividend of $1.64 next year.
That's our D1. You think that dividend is going to grow at a nice steady 4.5% a year forever. That's G. And your personal required rate of return, R, is 7.3%. So you plug those into the formula, D1 divided by R minus G, and you get a value of $61.21.
But let's get real for a second. The world is a messy place. So is it actually realistic to assume a company is going to grow at the exact same rate forever and ever? Probably not. That's a huge assumption, and it's really important to understand the limits of a simple model like this.
And yeah, that's the core problem, isn't it? I mean, think about it. A fast-growing little tech startup is not going to grow at the same rate as, say, a huge, established utility company. So does it really make sense to use one single growth rate, G, to describe a company's entire life?
No, of course not. The reality is that companies, just like people, have life cycles, right? They start out in a super high growth phase where everything is exploding. Then things start to slow down in a transition period, and eventually they settle into a more mature, stable, and predictable growth rate for the long run.
So professional analysts don't just stop here. They build on this foundation. They use what are called multi-stage models. So what they'll do is they'll project that high growth rate for maybe the next 5 or 10 years manually. And then, once the company is expected to be mature, they'll slap the Gordon growth model on the end to calculate the value of all those stable years way out in the future. It's a really smart way of combining a realistic short-term view with that powerful long-term formula.
So, what are the big takeaways here? Number 1, a stock's value, at its core, is just the present value of its future dividends. Number 2, the Gordon growth model is an amazing shortcut to estimate that. But here's the most important part, the big however. The answer you get is extremely sensitive to your inputs. Tweak that G or that R just a tiny, tiny bit, and your valuation can swing wildly. It can be the difference between a strong buy and a get this thing out of my portfolio. At the end of the day, the model is only as good as the assumptions you put into it.
Which really brings us to the best way to think about all of this. The dividend discount model isn't some magic 8-ball, a machine that just spits out the correct answer. It's a tool. It's a tool for thinking, a framework that forces you to think logically about the different levers that actually drive a stock's value.
And that leaves us with one last big question to chew on. If a formula like this can give us a logical, rational estimate of what a stock is truly worth, then why on earth do market prices jump around like crazy every single second of the day? What does that huge gap between calculated value and market price tell us about how markets really work? That's something to think about.